Accounting concepts and conventions. Accounting concepts and conventions are the basic rules, assumptions, and guidelines followed in the preparation and presentation of financial statements. They ensure uniformity, consistency, and comparability in accounting practices across organizations. Let's understand them in detail with examples. Accounting concepts 1. Business entity concept. This concept states that a business is treated as a separate entity from its owners. All financial transactions are recorded from the business's perspective and not the owner's. Example, if the owner invests 1 lakh rupees into the business, it will be recorded as capital introduced, not personal income. 2. Money measurement concept. Only those transactions and events that can be measured in monetary terms are recorded in the books of accounts. Example, a company's employee skills or reputation is not recorded in the books, even if they add value, because they can't be measured in money. 3. Going concern concept. It assumes that the business will continue to operate for the foreseeable future and will not shut down or liquidate. Example, if a company purchases machinery worth 5 lakh rupees, it will not be recorded as a one-time expense. Instead, its cost will be spread over its useful life through depreciation. 4. Cost concept. Assets are recorded at their original purchase price and not at their current market value. Example, if land was purchased at 10 lakh rupees and its current market value is 15 lakh rupees, it will still be recorded at 10 lakh rupees. 5. Dual aspect concept. Every transaction has 2 aspects, debit and credit. It is the basis for the double entry system of accounting. Example, if goods worth 20,000 rupees are purchased in cash, the inventory account is debited and the cash account is credited by 20,000 rupees. 6. Accounting period concept. The life of a business is divided into fixed periods, usually a year, to prepare financial statements and assess performance. Example, a company prepares its profit and loss account for the financial year April 2024 to March 2025. 7. Revenue recognition concept. Revenue is recognized when it is earned and not when cash is received. Example, if services are provided in March but payment is received in April, revenue is recorded in March. 8. Matching concept. Expenses should be matched with the revenue they help to generate during a specific accounting period. Example, if commission is paid in March for sales made in March, both are recorded in the same period. 9. Accrual concept. Transactions are recorded when they occur, not when cash is received or paid. Example, if salary for March is paid in April, it should still be recorded in March's accounts. Accounting conventions 1. Convention of full disclosure. All material and relevant information must be disclosed in the financial statements. Example, any pending legal case or contingent liability should be mentioned in the footnotes of the financial statements. 2. Convention of consistency. The same accounting policies and methods should be followed from one period to another. Example, if depreciation is charged using the straight line method, it should be continued every year unless a change is properly disclosed. 3. Convention of conservatism, prudence. It states that potential losses should be accounted for, but not potential gains. This helps in not overstating income or assets. Example, if the market value of inventory falls below its cost, it is recorded at the lower market value. 4. Convention of materiality. Only those items which are significant enough to influence decisions should be recorded. Example, expenses like 100 rupees on printing are treated as expenses, not as an asset, even if technically it's stationary. These accounting concepts and conventions ensure that financial reporting is accurate, transparent, and reliable for stakeholders, making them the foundation of sound accounting practices.